When you look at companies traded on the stock exchange today, what do you see? A clean logo, a professional board of directors, annual reports. But what if I told you that the foundations of modern capitalism were laid by a genocide company? Money doesn't talk. History does. And history tells us this. The first global company was not built on innovation, competition, or efficiency. It was built on monopoly, violence, and a state-backed license to kill. Most of us believe capitalism evolved naturally. We think markets emerged from voluntary exchange, that as societies became more rational, the system refined itself. But this story is as comforting as it is incomplete, because the financial system we live in did not begin with freedom, it began with control. In the 16th and 17th centuries, spices were not luxury flavorings. They were economic weapons. Nutmeg, cloves, cinnamon. These preserved food, in a world without refrigeration, were medicine in a world without antibiotics, and status symbols in a rigid social hierarchy. In Europe, a small pouch of nutmeg was worth more than its weight in gold. Control the spice trade and you don't just make money, you reshape entire economies. This is where the system stepped in. The problem was geography. Nearly all of the world's valuable spices came from a small cluster of islands in Southeast Asia. Whoever controlled those islands controlled supply, and whoever controlled supply controlled price. At first, European powers competed. Portuguese ships raced Dutch ships. Merchants undercut one another. Profits swung wildly. Some voyages brought fortunes, others only debt and corpses. This volatility scared investors. But what truly frightened them was the system itself. Every time each merchant flooded the market with spices, prices collapsed. Competition was good in theory, disastrous in practice for those financing the voyages. In 1602, the Dutch government did something radical. It merged several rival trading companies into a single entity, the Dutch East India Company, VOC. On paper, it looked like a financial innovation. It issued public shares. Investors could buy ownership, spread risk, and trade shares without ever boarding a ship. For the first time, ordinary citizens could invest in overseas expansion. But that wasn't the real innovation. The real innovation was the structure of incentives. The Dutch state granted the VOC a monopoly on all trade east of the Cape of Good Hope. No Dutch merchant could legally compete with it. No rival company could enter its territory. And unlike modern corporations, the VOC was not merely permitted to trade, it was permitted to govern. It could wage war, build forts, sign treaties, imprison enemies, execute smugglers. This was not a company operating within a state. It was a company operating as a state, with shareholders. Nothing says free market quite like banning everyone else. Once monopoly was secured, the profit mechanics became brutally simple. Control supply, restrict production, keep prices high. Anyone who threatened this balance was not a competitor. They were an obstacle. On the Banda Islands, then the world's only source of nutmeg, the VOC enforced exclusivity with military precision. The local population was ordered to sell only to the company at prices set by the company. When they resisted, the response was not negotiation, it was annihilation. Villages were burned, populations were massacred, survivors were enslaved or displaced, replaced with imported forced labor to maintain production. Excess nutmeg trees were deliberately destroyed, not because they were useless, but because abundance was bad for business. Scarcity was not a failure of the system. It was the system itself. Money doesn't talk. History does. And history shows us that profitability has always been less about morality than about structure. In Amsterdam, investors saw none of this. They didn't need to. Their VOC experience was clean, orderly, and financial. Regular dividends, rising share prices, meticulously balanced ledgers. Violence stayed overseas. Profits came home. This separation of profit and consequence may have been the AVOC's most enduring contribution to economic history. For the first time, thousands of people could benefit from imperial violence without participating in it, witnessing it, or even acknowledging it. Risk was abstracted, responsibility diluted, ownership reduced to paper. By the time the money arrived, the blood had already been scrubbed from the books. This was capitalism learning how to scale. The VOC didn't just trade spices. It pioneered a system where brutality could be converted into returns, power into dividends, and moral cost buried beneath layers of bureaucracy and distance. Investors didn't need to believe in conquest. They only needed to believe in efficiency. For a while, it worked spectacularly. The Dutch Republic grew rich. Amsterdam became a financial hub. The VOC became the most powerful company in the world, with a market value dwarfing many modern corporations. The VOC eventually collapsed. Corruption seeped in, management bloated, costs rose, control slipped. In 1799, it was nationalized by the Dutch state. On paper, it failed, but its logic did not. Because the VOC's true legacy was not its lifespan, it was its structure. Modern financial systems still rest on the same core mechanics: distance between decision and consequence, abstraction of risk, concentration of power disguised as efficiency, profits privatized, costs distributed across workers, regions, and time. The tools are different now. The language is cleaner. The violence is often less visible. But the incentives are strikingly familiar. When corporations gain regulatory protection, when competition quietly disappears behind legal barriers, when complexity shields accountability, when profits depend more on access than innovation, you are seeing echoes of the VOC. Not history repeating, but history evolving. That is why the idea of the free market is often more myth than reality. Markets do not emerge in a vacuum. They are built, designed, enforced, and the rules are rarely neutral. They reflect power. Who owns it? Who protects it? Who benefits when it is protected? Understanding this does not require cynicism. It requires clarity. The VOC was not evil because it was uniquely cruel for its time. It was brutal because brutality was profitable, and the system rewarded it. That is the uncomfortable truth at the center of economic history. Systems do not produce outcomes by accident. They produce them through incentives. And incentives do not care about intentions. Most people talk about capitalism as if it were a natural force like gravity or weather. It isn't. It is human-made. And like all human-made things, it reflects the values and power structures of those who built it. The danger is not the existence of markets, but forgetting how they are shaped and why. Because when you forget their origins, you start believing slogans. You assume fairness where there is advantage, neutrality where there is design, freedom where there is constraint. And that belief makes you vulnerable. Financial literacy is not memorizing definitions or predicting the next crisis. It is recognizing patterns of power, seeing how profit and authority intertwine, understanding that real wealth always flows to those who control systems, not merely those who participate in them. The VOC understood this 400 years ago. That is what made it effective. And that is why its shadow still stretches across the modern financial world. The lesson is not that capitalism is broken or markets are bad. The lesson is more precise and more useful. Capitalism was never neutral. It was designed. And once you see the design, you stop mistaking outcomes for accidents. History does not repeat because it must. It repeats because incentives remain familiar, and every generation believes it is finally operating within a different system. Money doesn't talk, history does. The answers are in the past,